Hello, I'm George Watchorn from Brown&Co. We're here today for the fourth instalment of our virtual farm walks. We're on a dairy farm in Leicestershire where we'll be talking about the state of the industry, looking at the various finance arrangements and options, looking at valuation considerations and also looking at the different land tenure arrangements.
Hi, I'm Olivia and I'm going to give you a dairy industry update. DEFRA recently announced that the June 2020 milk price was an increase on the previous month by 0.8%. The dairy industry was hit particularly hard due to the closure of the food service sector. Some farmers saw cuts to their milk price along with deferred payments, and as a result this led to some farmers dumping milk on farm. The timings of this coincided with the run-up to the spring flush, resulting in some farmers worrying that processors would not be able to process and collect the milk coming off farm. The UK lockdown dramatically saw a change in consumer habits, including where they shop and what they purchase. During lockdown, there was a rise in home baking, causing an increase in demand of butter, along with increased consumption of tea, coffee and cereals in the home, increase in demand for milk, along with more cheese being consumed in the home at lunchtime. During lockdown, it seemed like the public were more positive towards the dairy industry, with people resorting back to products that they've known and trusted. The spring flush was flattened this year due to farms reducing production at a request by their processors. This included cow numbers decreasing, drying off cows early and limiting yield growth. The weather and feed are now becoming a growing concern to farmers due to a dry May causing limited growth in grass, silage and cereals. The rain in June eased the situation, but it's not yet clear how this will affect the quality and quantity of feed. Milk production overall is expected to be down 0.7% overall. In the longer term, the industry must build and maintain on this consumer trust, demonstrating the farming values, including animal and environmental welfare, and sharing these with consumers. Almost half of dairy farmers' revenues go towards paying off overhead costs. Higher profit margins are usually associated with lower production costs, regardless of what calving system is in place. Minimising overhead costs is a characteristic of top-performing farms, regardless of sector. Full economic production costs must include all non-cash costs, including building depreciation and unpaid labour. Cost efficiency is usually overlooked, but it can make your business more resilient to future milk shocks. Approximately 30% of calves born on a dairy herd are heifer replacements, and 95% of the remainder are raised for either beef or roseveal. There's been progress throughout the years by farmers, milk buyers and processors to ensure that calves are utilised across the food chain. The dairy industry is committed to banning the euthanasia of calves by 2023, and the rearing of calves for beef has remained relatively high on farms. The industry continues to improve calf health, welfare and survival. One supermarket retailer has announced it will compulsorily purchase a minimum of 20% of the beef calves from its milk producers starting in 2021, using one of two Angus sires at a fixed price for bull and heifer calves to ensure it sells more of its own beef in store. In summary, these industry challenges support the importance of forward planning when faced with rising inputs and lower production income, which may not have been budgeted for. It is vital to maintain a relationship with your bank in case further funding is required in the future.
Hi, I'm Paul, and I'm just going to talk about some of the considerations with financing, because we're getting more and more requests about finance and it seems the marketplace is changing. So firstly, if you've got a project or something that you think might need external financing, the first bit is to decide how you're going to finance it. A lot of people firstly go to the overdraft, which isn't always the right place to be, especially if it's a long-term capital investment. And what can then happen is you spend the money out of your overdraft and later in the year you have cash flow problems. So first point to decide on how you're going to fund it. Is it something working capital wise which can be done from the overdraft, or should it be a loan? The second thing to consider is where do you go with that? And your first point of call with that should be your existing bank. They know your business, they know your credit rating, and they know what your cash flow challenges are. There's no harm in asking for a second quote, and your banker won't object to that. because there are some specialist lenders out there who specifically deal with projects such as renewable energy, anaerobic digestion, machinery, and in some cases even livestock. So once you've identified the type of funding and where you think you'd like to go for it, probably the most important factor is then to look at something called serviceability. Historically, agriculture has always been a safe place for banks or lenders to loan money to. But what's happened since the last recession, everybody is looking for something called serviceability. So no longer does it matter that you've got a lot of capital and security, it's how you're going to repay the loan which is important. And banks actually have to do due diligence, checking that you have the ability to do it. And the challenge with this is quite often, in farming we've always said it, that capital rich, cash poor. So you will need to do some form of forward budgeting to prove that you will be able to repay the loan. And that's what serviceability is called. This area is going to become more challenging as we go further down the transition period and the BPS payment reduces, because basically for the majority of farm businesses, the profit of the business equates to nearly all of the BPS. So we are going to have to review how our businesses are performing. So hopefully you've done your due diligence, you've done your serviceability, you've got someone to help if you can't do it yourself, you've done your budget. You then need to decide whether you go fixed rate or variable as far as the interest. Again, this is your business's view on risk, whether you want to know what you're going to pay for the next 5, 10, 15 years without any variation, or if you take the view that actually you may have the ability to pay off the loan early, you might then want to go down the variable route or a mixture of both. So to summarize, two things. The first point is serviceability. It is worth doing the forward budgeting to check that you will be able to pay the loan back. And the second point is timing. Make sure you ask for advice, speak to the bank soon enough, because quite often projects have strict timelines, and if you don't start soon enough, you may end up with the wrong finance solution. Thanks.
Hi, I'm George Watchorn and I'm here today to talk about farm business tenancies and grazing licences. Particularly with reference to stock farms, land that forms part of the business is not always owned, and therefore these agreements are occupied on either farm business tenancies or grazing licences. We're still coming across situations where land has been taken from neighbouring landowners on a gentleman's agreement or a handshake. It's fundamental that whatever has been agreed is documented in the right form. The absence of a written agreement can have severe implications for both landlord and tenant, or licensor and licensee, particularly in the event where a dispute arises, or more so probably where the landowner may be looking to borrow funds and needs to use the land for security purposes. The essence of a farm business tenancy agreement is that it gives the tenant full management control, and in return they claim the annual subsidy known as the basic payment scheme. When entering into these agreements, consideration should be given to the length of term of the FBT. An FBT that has an initial term of more than two years will need 12 months notice to quit serving for it to expire on the term date. Other considerations that landowners should be taking into account when thinking of entering into an FBT is, should they have their soil tested prior to the commencement? This can act as a base measure and protect the land from any future dilapidations. Another point would be to consider, are there any buildings included within the FBT? And what value do these buildings provide to the surrounding land? Because this will need to be calculated into the rent. Similarly, if there are buildings, you should be looking to have a schedule of condition undertaken at the commencement. So any dilapidations can be recorded and dealt with appropriately through end of tenancy matters. As previously mentioned, we also need to consider, will the landowner be looking to borrow any funds in the future? From a valuation perspective, if there's a tenant in occupation on the land, it's a valuation consideration, and the capital value that they're looking to borrow against will be less than if the land was vacant. Tenants should also have a number of considerations before entering into farm business tenancy agreements. They should be considering, does the length of term give them enough security for them to make investments within their own business for the longer term? They also need to consider whether they want to be making any capital investments in machinery or fixed equipment, such as putting a new building up, and how these might be treated at the end of the tenancy agreement. Are they going to be treated as a tenant's improvement, or will they be classed as a tenant's fixture? The other form of agreement which landowners can let their land on is a grazing licence. These are normally much shorter agreements, probably from no longer than 6 months of the year. Here it's fundamental that the licensor, the landowner, retains sufficient management control, as he will be claiming the annual subsidy, the basic payment scheme. Prior to entering into a grazing licence, licensors should consider, can they demonstrate sufficient management control? If they can't, it would be probably more appropriate for the occupation to be documented under a farm business tenancy agreement. The main consideration for the licensee in taking on a grazing licence should be that whether, if I lose this land tomorrow or that it's not renewed in the following year, how will this impact upon my business? Will it still be sustainable without it? Will it impact on growth? And all of these things will then lead to whether it's going to be sustainable for any finance arrangements that you've taken out previously, and whether it's going to impact on your ability to meet that if you lose further land. There are lots of different factors that need to be taken into account when considering the different tenure arrangements. Summary to all of them is: 1. Is the type of agreement going to meet both the landlord and tenant, or licensor and licensee's objectives? 2. Is it sustainable and one that will last for the future? 3. Does the agreement type adequately deal with those items that have been invested with on the holding? Many of these factors can be addressed at the outset by entering into discussions with the landowners and their advisors in good time. The legislation surrounding the different tenure arrangements is sometimes complicated, but it is so vitally important that what's agreed is documented in the right form prior to the commencement of any agreement.
Hi, I'm James. I'm here to talk to you about security that you put forward for your valuations. Farms are a fantastic asset. They're versatile, offer a good steady rate of return, and provide plenty of opportunity to diversify income streams. When looking at valuations, you always concentrate on returns of the project that you're investing into, together with the cost of the money. It's also important to consider the assets that you're putting forward as security for the lender. The lender is looking to ensure that they have a suitable loan to security ratio. However, what you need to consider is the impact on putting this security forward for your farm. What is often surprising is the thought that is put towards the security. Often we receive as valuers a plan with a red line indicating that all of the land is to be included within a valuation. However, sometimes this exceeds what is actually required from a lending perspective, and also places a charge across the whole property. It is important to categorise your assets accordingly and ensure that the elements that you put forward first as security are those that impact least on the holding. Important considerations when putting forward security for lending is know exactly what is required in terms of a monetary value from the lender. Secondly, work this back on a per acre basis. This ensures that you're providing the amount of security required without overexposing your assets. Thirdly, we would suggest you work on an outward-in basis. Start with land that's offlying or further away from the main farmstead, working back in as required to try and reduce the exposure of the main farmstead and houses, etc., that are included within your assets. If that doesn't provide sufficient coverage, then start looking at the assets individually, including farm buildings, ranges of traditional buildings, farmhouses and let cottages. It's important to start really with let assets that again are offlying or less fundamental to the holding, and then work back towards your farmhouse and the main resident. Once your security has been selected, it's then useful to look at how this will impact on the holding and also how this will impact the valuation. If you're offering part of a property as security, then you need to consider how that sits within the farm, how the security will be viewed by the bank, and ultimately the impacts that will have on the lending available. Things to consider: items such as access. If you're offering part of the holding to the bank, then ensure that it's got its own separate access or a defined access route, rather than dissecting a farm, which in turn will reduce the values should part of it be sold away. Secondly, you should look at the third-party occupations on the farm, whether these are grazing licenses, farm business tenancies, cottage occupations or let farm buildings. You need to ensure that these are all correctly documented. Finally, just ensure that the ownership details are correct and that the parties applying for the finance are either in ownership or there's a clear defined route to that ownership, to ensure that no queries are raised in the report on title carried out by the legal team when drawing down the loan. Bank valuations are a fundamental part of obtaining lending. It is important to consider the security that is being offered. Not only will this ensure a simpler application period and speed up an eventual purchase or drawdown, but will ensure, should future opportunities present themselves, then the assets are free from security and will allow them to be utilised accordingly.
Thank you very much for watching. We hope you found the talks informative. If you want any more information or would like to contact the local office, please visit the website at brown-co.com.